Okay, let's unpack this. The world of financial planning, especially retirement savings, it can often feel like navigating a dense forest, right? Full of intimidating jargon, winding paths. But today, we're going to try and be your guides, cut through some of that complexity. This deep dive is all about retirement accounts, IRAs, qualified plans, and taxation. We've gathered insights that really give a comprehensive look at how these accounts work, how they're taxed, and importantly, what powerful benefits they truly offer.
Exactly. And our mission for you, our listener, is really to distill this down, get to the most important nuggets of knowledge. We want to help you understand the core mechanics, the significant differences between these really essential financial tools. And what's fascinating here, I think, is how seemingly small differences in these accounts can have a huge impact on your long-term financial picture. So we'll highlight some surprising facts, crucial distinctions, so you can walk away feeling, well, truly well-informed.
Right. Let's kick things off with the big picture then. How does money actually get taxed within these plans? It's not just one thing. It's more like a story told in three distinct phases. And understanding these phases really simplifies things once you get it.
That's a great way to put it. These three phases are contributions, investment growth, and distributions. So when we talk about contributions, that first phase, we're basically looking at pre-tax versus post-tax.
No.
When you make pre-tax contributions, it immediately reduces your taxable income for that year. So say you earn $100,000, you contribute $10,000 pre-tax.
Okay.
The IRS only taxes you on $90,000. You avoid income taxes on that 10 grand in the year you earned it. That initial $10,000 and, well, the entire amount, if it's all pre-tax funded, it's considered to have a zero cost basis,
That,
which basically just means for tax purposes, you haven't paid taxes on any of that money yet. So when you eventually take it out in retirement,
it's all taxed then.
right, the entire amount will be taxed as ordinary income.
Okay, so that's the upfront tax break. Makes sense. What about when your money is actually in the account, growing over years, sometimes decades?
Well, that is the investment growth phase, and it's truly powerful. All the activity within these plans, things like dividends, interest, even buying and selling securities, it's all tax sheltered or tax deferred,
Yeah.
meaning you don't pay taxes on those gains or income as they happen year after year. The money just compounds undisturbed by the tax man until you actually withdraw it.
Okay. And finally, distributions. That's when you actually start taking your money out in retirement.
Yeah.
How does that work, tax-wise?
So for distributions, if your funds went in pre-tax, they're typically taxed as ordinary income when you withdraw them. Simple enough. But if you contributed post-tax funds like you do with a Roth account, those distributions are generally free from taxation.
Completely tax-free.
The contributions, yes. And there's a special case, too. Certain plans, think Roth IRAs and 529 college savings plans, they can allow owners to avoid taxation even on the plan's growth, provided the assets are used for their intended purpose and held for a minimum time. That's a huge benefit.
Wow, okay. So what does this all mean for you, the listener? It really means understanding these tax phases and then, strategically choosing the right account type that can significantly impact when and how your money is taxed. It gives you some powerful advantages over the long term. It's really about optimizing your financial future. All right, let's shift gears now. Let's move to accounts you as an individual can set up directly. We'll start with the classic traditional IRAs, and then we'll look at Roth IRAs, which you could kind of think of them as their maybe cool younger sibling. So a traditional IRA, it's a choice many individuals make, funded directly by your own contributions. It's worth mentioning, though, financial advisors often recommend fully utilizing any employer plans first, if you have them, often because of potential lower costs and maybe even employer matching funds.
That's a good point. And eligibility for a traditional IRA is pretty broad. Anyone with earned income from employment can contribute, doesn't matter what your age is. But it's important to remember what earned income actually means. It's income from your work wages, salaries, commissions, professional fees, even taxable alimony counts.
That doesn't count.
Right. It does include passive income, things like your investment gains, dividends, interest, rental income. That's a key distinction when you're figuring out how much you can contribute.
Okay. Speaking of how much, when it comes to contribution limits,
Yeah.
how much can you actually put in annually?
For most people, the maximum is the lesser of $6,000 or 100% of your earned income for the year.
And just a heads up here, any contributions over this limit, they're subject to a 6% tax penalty. So it definitely pays to be precise. Now, here's where it gets really interesting. What about folks who might be, say, over 50, maybe getting a slightly later start on saving? Do the limits offer any flexibility there?
Yes, absolutely. And this is fantastic. For individuals 50 and older, the IRS allows an additional catch-up contribution. It's currently $1,000, so that brings their annual limit up to $7,000. It's a really crucial detail, can significantly boost savings for those closer to retirement.
And contributions have to be cash, right? Not
Yeah,
property or anything.
correct. Always cash, never property.
Okay. And what about deducting those contributions for your taxes? That's a big part of the traditional IRA appeal, isn't it?
It really is. So, if you are not covered by an employer-sponsored retirement plan at work, you can generally deduct your full traditional IRA contribution up to the limit regardless of your income.
But what if you are covered by a plan at work?
Well, if you are covered by an employer plan, or even if your spouse is covered by one, then the deductibility of your contribution actually depends on your taxable income. There are income phase-outs.
So it gets a bit more nuanced there.
Exactly. It's always worth checking your specific situation against the current IRS guidelines.
Right. And once the money's in the IRA, you're basically in the driver's seat, investment-wise.
You are. You choose where to hold the IRA, could be a bank, could be a brokerage firm, and you decide on the investments. Stocks, bonds, mutual funds, annuities. Even U.S. gold coins are allowed.
Dog's not allowed.
Good question. You can't put in life insurance policies or collectibles, things like art, antiques, stamps. Those are prohibited investments.
Okay. And a couple of other key rules.
Yeah, you cannot trade on margin within an IRA, and it's absolutely crucial, really essential, to designate a beneficiary for the account.
Got it. Now, what about married couples? Say only one spouse works outside the home. Can they both save in IRAs?
Yes, they can. This is the spousal IRA rule. Even if only one spouse is employed, the couple can contribute up to a combined maximum currently $12,000 annually into two separate IRAs. The key conditions are that the working spouse must earn at least that combined amount, $12,000 in this case, and no more than the individual limit, $6,000, can go into any one person's account.
So $6,000 max per person.
Exactly. It's a great way for a household to really maximize their retirement savings, even with only one primary income earner.
That's useful. And what about flexibility? If you need to move funds, say, from one IRA provider to another.
There's good flexibility there, too. You can do what's called a transfer. That's where the money moves directly from one trustee, like a brokerage, straight to another trustee. These are unlimited, and there's no tax implication. Very straightforward.
Okay, and the other option?
The other option is a rollover. This is where you, the investor, actually receive the money from the first institution. Now, to avoid taxes and penalties, you must deposit that money into another qualified retirement account within 60 days.
60 days. That's the key window.
60 days is critical. And here's another crucial detail. You can only do this type of rollover where you physically receive the funds once every rolling 12 months per IRA.
Only once a year. Missed that rule.
And you're looking at potential taxes and penalties. It could be treated as an early distribution. So transfers are generally simpler if you can do them.
This raises an important question, though. What happens if you need the money before retirement? You need to tap into your IRA early.
That's a common concern. If you withdraw from a traditional IRA before you reach age 59 and a half, you'll generally face a 10% tax penalty on the amount withdrawn.
Ouch.
And that's on top of the regular ordinary income taxes you'll owe on that pre-tax money.
Intricate. So it's a double hit. Can you give an example?
Sure. Let's say a 40-year-old, maybe earning $45,000 a year, takes a $5,000 withdrawal from her traditional IRA. She'd likely face a $500 tax penalty. That's the 10% plus. That $5,000 gets added to her income for the year. So her taxable income effectively jumps to $50,000. It can be quite costly.
Definitely something to avoid if possible. Are there any situations where that 10% penalty might be waived?
Yes, thankfully, the IRS does recognize certain significant life events. The penalty can be waived for things like total and permanent disability, or if the account owner passes away, the beneficiary can withdraw without the penalty. Also, for certain large unreimbursed medical expenses or health insurance premiums if you become unemployed.
What about major life purchases or events?
Yes, there are exceptions there too. For a qualified first-time home purchase, you can withdraw up to $10,000 penalty-free. That's a lifetime limit, though. There's also an exception for expenses related to the birth or adoption of a child, up to $5,000 per event. And for qualified higher education expenses for yourself, your spouse, kids, or grandkids.
So there are some important exceptions.
There are, but, and this is really important, even if you qualify for an exception to the 10% penalty, you still owe ordinary income taxes on the withdrawn amount, assuming it was funded with pre-tax dollars.
Right, the taxes still due.
And one more very critical point. Just facing general financial hardship, unfortunately, does not waive the 10% penalty on its own. It has to be one of those specific IRS exceptions.
Okay, very clear. So we've talked about taking money out too early. But what about the flip side? When the government basically says, okay, enough saving, time to start taking that money out whether you need it or not. That's where required minimum distributions or RMDs come in, right?
That's exactly right. And the rules around RMDs, they actually changed not too long ago with the Secure Act of 2019. For most people now, you must start taking withdrawals, your RMDs, by April 1st following the year you turn age 72. It used to be 70 and a half, but now it's 72.
And what if you don't? What if you miss taking your RMD?
Well, the penalty is hefty. It's a 50% tax penalty based on the amount that should have been withdrawn but wasn't.
50%.
Yes, 50. It's almost like the government saying, look, you've enjoyed this tax deferral long enough. It's time to pay the piper and get that money circulating. It can be a real shock if you're not prepared for it.
It certainly sounds like it. Okay, let's switch focus now to Roth IRAs, introduced back in 1997. So if traditional IRAs are all about getting that tax break up front, what's the big game changer with Roth IRAs? It flips the script on taxes, right?
It absolutely does. With Roth IRAs, you contribute after-tax dollars. That means there's no immediate tax deduction when you put the money in.
Okay, no upfront break. So where's the magic?
The magic happens later. Here's where the Roth IRA truly shines. Because you pay taxes upfront on your contributions, you can withdraw those contributions themselves at any time for any reason, completely tax-free and penalty-free.
Anytime. So even before 59 and a half.
Your contributions, yes.
Yeah.
No penalty, no taxes, no questions asked. It's your money you already paid tax on. And here's the kicker. The accumulated earnings in the Roth IRA can also be withdrawn completely tax-free, provided two conditions are met.
Okay, what are they?
First, the account must have been open for at least 5 years. That's the 5-year rule. And second, you need to meet one of the qualified distribution conditions. These are similar to the penalty exceptions for traditional IRAs, being age 59 and a half or older, death, disability, using it for a qualified first-time home purchase, up to that $10,000 lifetime limit, birth or adoption expenses, up to $5,000, certain medical costs, or qualified higher education expenses.
So if you meet the 5-year rule and D, one of those conditions?
Okay. Then all of the growth, potentially decades of investment earnings, comes out completely tax-free. No federal income tax at all on that growth. Think about that compounding power over time.
That is a massive difference. And there's another huge advantage that sets Roth IRAs apart from traditional ones, isn't there? Regarding RMDs.
Yes, this is a major one. There are no required minimum distributions for the original owner of a Roth IRA.
Not at all.
None. So you never have to take money out during your lifetime if you don't want to or need to. You can let it keep growing tax-free potentially for your entire life.
Wow, that's a huge point for flexibility and estate planning.
Absolutely. Now, contribution limits for Roth IRAs are the same as traditional IRAs. It's the lesser of $6,000 or 100% of your earned income, plus that $1,000 catch-up if you're 50 or older. And a very important point. Your total contributions to all your IRAs combined, traditional and Roth, cannot exceed that annual limit. You can split it, but the total can't go over.
Got it. What about eligibility? Can anyone contribute to a Roth?
Well, there's no age limit. You just need earned income. But unlike traditional IRAs, where deductibility can phase out, Roth IRAs have direct contribution limits based on your income. If your income is too high, you might not be able to contribute directly.
Ah, okay. So higher earners might be blocked.
They might be blocked from direct contributions. However, and this is a crucial distinction many people leverage, there is no income limit for converting a traditional IRA into a Roth IRA.
The backdoor Roth.
Exactly. It's a well-known strategy that allows higher earners to effectively get money into a Roth account, even if they can't contribute directly. They make a non-deductible contribution to a traditional IRA and then convert it.
Interesting. Okay, we've covered individual accounts pretty thoroughly. Let's shift gears now to plans your employer might offer. These are often called qualified retirement plans, and they operate under a bit of a different framework.
Right. And if we want to connect this to the bigger picture, these plans are primarily governed by a major piece of legislation called the Employee Retirement Income Security Act, or ERISA. You hear that term a lot. ERISA's main purpose really is to prevent misuse and mismanagement of pension funds. It sets strict standards of conduct for the people managing these plans, the fiduciaries. So qualified retirement plans, they meet the requirements of both ERISA and the IRS, and that's precisely why they get such favorable tax treatment.
Okay, so what are the key characteristics then that define a qualified plan? What makes them special?
Generally, they feature pre-tax contributions, often from both the employer and the employee. Critically, like traditional IRAs, the investment growth within these plans is tax deferred. You don't pay income tax on the earnings until you withdraw the money, usually in retirement.
And you mentioned fairness earlier.
Yes, a really big one for qualified plans is non-discrimination. They cannot be set up just to favor the highly compensated employees, like executives. They must benefit a broad range of workers within the company according to specific testing rules.
Makes sense. What are the benefits then for employers and employees?
Well, for employers, they get valuable tax deductions for the contributions they make to the plan. Plus, offering a good retirement plan is a powerful tool to attract and retain valuable employees, especially in a competitive job market.
And for the employee?
For employees, when you defer part of your salary into the plan, that immediately reduces your current income tax liability because it lowers your reportable taxable income for the year. It's deferred income. So it's often seen as a win-win.
Okay. And what specifically makes a plan qualified in the eyes of the IRS and ERISA? What are the technical requirements?
Well, first, it has to be established in writing. There needs to be a formal plan document. Then there are specific eligibility requirements. Generally, the plan must cover employees who are at least 21 years old and have worked for the employer for at least 1 year, defined usually as 1,000 hours of service in a 12-month period.
And didn't the Secure Act change that slightly too?
It did. It added another pathway for part-time workers. Now, employees can also become eligible if they complete 3 consecutive years where they work at least 500 hours per year. That broadened eligibility quite a bit.
Okay. What else?
Then there's the concept of vesting. This is really important. Vesting refers to the employee's ownership right to the employer's contributions. There are minimum schedules set by law. For example, a plan might have cliff vesting, where you're 0% vested for a few years and then suddenly 100% vested after, say, 5 years. Or it could be graded vesting, where you gradually become vested over several years, like 20% after year 3, 40% after year 4, and so on, until you reach 100% after maybe 7 years.
But your own contributions are always yours.
Right. Absolutely crucial point. Employees are always 100% vested immediately in their own contributions and any earnings on them. Vesting only applies to the employer's match or profit-sharing contributions.
Got it. And the investments.
The investment of the plan assets and really all plan activities are governed by strict fiduciary guidelines under ERISA to protect the participants' interests.
Okay. So within these qualified plans, are there different types?
Yes, broadly speaking, there are 2 main categories: defined benefit plans and defined contribution plans.
They sound similar, but I gather their implications for the employee are fundamentally different.
Oh, completely different. A defined benefit plan, you might think of this as a traditional pension, promises a specific guaranteed payout to the employee at retirement. That payout is typically based on a formula considering factors like salary history and years of service. The key here is the investment risk for funding that promised payout falls squarely on the employer.
Okay. Guaranteed benefit, employer risk. What about defined contribution?
With a defined contribution plan, the focus is on the contribution going in. That amount is fixed, perhaps a percentage of your salary matched by the employer, but there's no guaranteed benefit amount at retirement. The amount an employee ultimately receives depends entirely on how much was contributed by them and their employer, and crucially, how well those investments performed over their working years.
So the risk shifts.
The investment risk is primarily on the employee in a defined contribution plan.
Okay. What are some common types of these defined contribution plans?
One common type is a profit-sharing plan. These are solely funded by the employer, and the contributions are usually discretionary, meaning the employer can decide each year whether to contribute and how much, often based on company profits.
So it's flexible for the employer.
Very flexible, especially for companies with unpredictable cash flows. If they do contribute, the funds have to be allocated to employees according to a predetermined formula, often just a percentage of each employee's salary.
Makes sense. And the big one, everyone knows.
The 401k plan, probably the most well-known type of defined contribution plan today. They provide retirement benefits based on the total value accumulated in an employee's individual account at retirement. Both employers and employees can typically contribute to these plans. Employee contributions are often made pre-tax, lowering current taxable income, and all the investment growth is tax deferred.
And the employee usually chooses investments.
Yes, employees typically decide how to allocate their own contributions, and sometimes the employer's contributions too, from a menu of investment options selected by the employer or plan provider.
Now, when we think about 401ks, you mentioned risk being on the employee. There's one specific risk or maybe a caution that financial pros really emphasize, especially for folks nearing retirement. What stands out to you there?
You're absolutely hitting on a huge point. The danger of investing too heavily in your employer's stock within your 401k.
Why is that so risky? It might feel like loyalty, or maybe it's performed well.
It might feel like that, but think about it. You're putting all your eggs, or a very large portion of them, into one single company's basket.
Hmm.
Your retirement savings and your current job security are both tied to the fortunes of that one company. If that company's stock takes a significant downturn, especially when you're close to retirement and don't have decades to recover, the impact can be devastating. It's a major concentration risk that, unfortunately, many people don't fully appreciate until it's too late. Diversification is key.
That's a really sobering point. Okay, and finally, there's a variation on the 401k, right? The Roth 401k. How does that fit in?
Yes, the Roth 401k option has become increasingly popular. It resembles a regular traditional 401k in many ways. Contribution limits, employer matching rules often apply similarly. But the key difference, just like with Roth IRAs, is that employee contributions go in after tax.
After tax, so same benefit as the Roth IRA then.
Exactly the same core benefit. Because contributions are after tax, qualified withdrawals from Roth 401k plans in retirement are exempt from federal income tax. This means you don't have to pay taxes later on any of the capital gains, bond interest, or dividends earned within that Roth portion of your account. It's that same powerful tax-free growth principle, just offered within an employer-sponsored plan.
Okay, so we've really covered a lot of ground today. We started with that fundamental tax story, contributions, growth, distributions. Then we dove into the individual accounts, the traditional and Roth IRAs, highlighting their key differences, rules, pros, and cons. And finally, we looked at the employer-sponsored world of qualified plans, RISA, defined benefit versus defined contribution, profit sharing, 401ks, and those Roth 401ks. We've really seen how powerful that distinction is between paying taxes now, post-tax like Roth, versus paying taxes later, pre-tax, like traditional, and how that affects tax-deferred versus tax-free growth.
Right. And understanding these nuances, these differences, really allows you to apply this knowledge effectively for your own specific situation. Because at the end of the day, knowledge is really most valuable when it's understood and then actually applied.
Absolutely. Because even with all these rules and benefits laid out, the real power isn't just in knowing them passively, is it? It's in actively adapting your strategy as your own life changes. So here's a thought to leave you with. Given these powerful tools, these clear tax advantages we've discussed, how might your evolving life circumstances, maybe a new job with different plan options, a significant jump in income, or even just hitting a new decade like 50 or 60, how might those changes prompt you to actively reassess, maybe fine-tune your own retirement saving strategy to truly maximize these benefits for your future? Something to think about as you continue on your own deep dive into financial well-being.